of the biggest misconceptions about forex trading is that chart patterns do not work. You realize that so many traders actually focus on doing the most complicated things to make money in forex. So you hear so many people say chart patterns does not work because they want to see complicated lines on their charts before they take advantage of trading opportunities. Quite often than not, you realize that most of the people who say chart patterns do not work actually do not have any basic or objective rules governing how they trade with chart patterns. You end up jumping in too early, too late, or you might even not be able to take this trade at all because you're seeing a chart pattern play out, but you do not have an entry criteria or rules that enable you to know exactly when to jump in on a trade. A lot of people fail to understand the price action of candlesticks when it comes to working with chart patterns. In today's video, we'll be looking at my favorite chart pattern and how I've been able to use it to maximize my gains on trades for about 4 years now. I've actually shot a video on this pattern before, but I used it yesterday to take a trade on oil, making over 300 pips in the process. If you are here and you can't wait for me to start this video, as always, make sure you're subscribed to the channel. Make sure you like this video, extremely important. Also, make sure you share with as many retail traders as possible. We'll be right back. Like I said in my trading technique video, we have reversals, we have continuations, we have breakouts, we have retests. There are so many scenarios you can use to trade on the market, and this is one of the continuation techniques. A continuation mostly happens when you are expecting the market to reverse in a particular instance, or when the market actually takes a pause in a particular point where you are expecting a reversal and it ends up continuing the prior or previous move. It happens a lot. You might be on a support, you're expecting a reversal, you see the market consolidate, and then all of a sudden there's a nice breakout that continues to go in the previous direction. Without wasting my time, let's delve into the chart so I explain to you how this pattern looks like and then how I use it to take advantage of my continuation or my breakout trades. Hey guys, so as you can see clearly on my screens, we are looking at US oil. This is the trading position. Currently my stops are at entry, waiting to see if I might milk as much as possible. I've already taken about 90 pips of my profits from this particular trading position already, over 300 pips on this particular setup. So now let me just take you back and then explain to you what this particular pattern means and then how I'm able to use it to maximize my gains. It's basically a bearish continuation chart pattern. It means that normally you have a nice or a huge drop, then the market actually takes a pause, consolidates for a bit, then it drops again. So let's say you normally have the market drop this way, then you see it consolidate. Consolidation simply means that you see a few candlesticks playing out here as if it's going to actually reverse. I normally look out for at least 3 candles, 3, 4, 5 candles normally consolidate here, then it finally takes another opportunity to now break out and go back to the downside. So it normally happens this way. So with this particular strategy, I always look out for my consolidation here, then I wait and see how the candlesticks play out here. If I'm looking for a continuation, it means that I'm basically wanting to see any price action that indicates the market is going to go for a sell. It means I look at the various candlesticks, how the candlestick patterns play out here. If it's a bearish continuation, it means I'm expecting it to continue to go down. On the other side as well, you can also have the bullish continuation pattern where the market will rise initially. You have a long rise. Same way, candlesticks will also consolidate here nicely, up, down, about 3, 4, 5 candles. Then eventually it breaks to the upside. You're also looking for a breakout to the upside, but you want to see it happen after the consolidation. Same way, you want your price action to explain to you that this market is actually going to be a continuation trade. It means that you want to see any confirmation that tells you that the bullish run is going to continue. Same for this scenario as well. You want to actually also see a bearish presence or a bearish confirmation that tells you that the market is going to go for a sell. So in so many instances, you realize that the market might actually be sitting nicely on a support. So let's say you see a low, you mark out your support this way, expecting the market to reverse, come back to hit the support. So you're able to catch a buy. So it means that you're mostly expecting the market to maybe drop, come back here, then you're able to catch a buy to the upside. But there are so many instances where the market comes to your support, you see it consolidate a bit, but it ends up being a breakout to the downside. So if you are someone who is mostly fond of taking trades or mostly fond of setting pending orders at your support or resistance zone, expecting the market to automatically go for a buy or a sell, you realize that there are so many instances where you lose money because you fail to understand what the price action here tells you. So in today's video, I'll be explaining to you how you can actually take advantage of a sell here, even when you're angling for a reversal for a buy. So I was actually even driving yesterday when I actually took this trade. I just spotted a pattern on oil and I decided to just take a small short position on it to see how far it goes before I send it out to my Telegram community. And then by the time I realized, it was already floating about 150 pips profits. By the close of the day, I've actually touched over 300 pips on this particular trading position. Now let's go back to the oil chart so I explain to you where I found my entry and then how I took advantage of it. So remember how I always do it on my charts. I always mark out my most recent high as my resistance, my most recent low as my support, waiting for the market to tap into that particular level. Then I take advantage of that. And then, like I said, I can simply use a pending order to make sure I receive a notification anytime the market touches any of my key levels by simply using the add alert symbol we have up here. So once you do this, all you need to do next is to just wait for the market to actually tap into your zones. Wait for the market to actually tap into. So you realize that finally the market taps into our support, pulls back a bit. Like I said, there are so many traders who simply just come and take a buy because the market has tapped into their support. That's how you blow accounts, taking trades without following your rules. So I keep following my rules because if I don't have a confirmation, I'm not trading now. So I'm simply waiting. You realize that the market comes back to tap into the support range again. Then we have a small candle play out there. So we realize that you see the market would start consolidating along the support here. I don't have a confirmation for my buy yet. I also don't have any confirmation as to whether the market is going to be a breakout and continue to the downside. So I simply keep waiting for the market to give me what I'm actually looking for. So finally, I see this particular. So we realize that now I have the pattern I was looking out for. Drops to my support. Then I see the market consolidate. Then this candlestick pattern here, the price action, the candlestick pattern I see here is actually a bearish confirmation, telling me that the market is most likely going to continue to the downside. This is actually an evening star, expecting the market to continue to the downside. So now I simply just bring my risk to reward. My entry price is right here. My stop loss is right on top of my consolidation. It's right on top of the consolidation of the candlesticks I have here. So I'm not risking much. For oil, trust me, for oil, this is very small to risk as your stop loss. Then I look at the price action because I want to see how far I'm expecting the market to go. So you realize that I see this price here as my reference point. So it means that if long term I'm expecting this to be a huge breakout and go all the way down, I'm at least looking at the price here, which is about 198 pips. So let's say 200 pips. So now I look at this particular point. So I know that this is the next low here. So if it breaks out of this particular support, I'm expecting it to at least get to this low, which is about 200 pips away. So that was where my TP2 was. My TP1 was basically, you know what I always say about my TP. TP1 is basically what you are risking. So if you are risking about 50 pips on oil, your TP1 should be, just make sure your TP1 is very similar to what you risk as your stop loss. So my TP1 is here, my TP2 is on this next support. Then finally, if I want to hold it as a swing trade, I look at the overall price at the bottom here. If I'm expecting oil to go all the way down based on what I see on the market, and now look at what the 500 pip range to see if it's going to keep going in my favor. So now I just come back, zoom in, and then wait for the market to do the rest because I've basically set all my levels, waiting for the market to do the rest. Then what do we see? We hit our TP1. What does the next candle do? Smashes, runs through our TP2. Let's see how many pips we've actually made on this particular trade already. Over 290 pips, almost 300 pips on this simple trading setup. So you realize that it's a simple chart pattern I used to identify the breakout or my continuation sell here. Running through down, I use my reference point, which is what the next support at the bottom, as at least the target I'm expecting to make on this trade. Then what do we see? The market runs through both levels. I make my profits. I take 90% of my profits off the table. I leave 10% on running. My stop loss is what, as we always say, is at entry, basically. So now you're running a risk-free trade, having nothing to lose. So you can hold your trade as a swing trade as much as possible. So on your screens, it's a screenshot of the trade I took. You realize that it's as simple as I always say it is. I like to keep things simple. I like to keep things basic as much as possible. Less is more, guys. Less is more. Always trade what you see, not what you feel. And then, like I always say, do more of what works and then less of what doesn't. So if you find this video extremely helpful, like we always say, make sure you subscribe to the channel. Also share with as many retail traders as possible. I want you to get this information out there to as many people who are interested in trading Forex as much as possible. If you also want to join a community of traders who help each other grow to become amazing traders, there's a link in my description which takes you to my Telegram community with over 12,000 active traders, the Common Forex trading community on Telegram. Also click on the link in the description to sign up with my recommended broker with the tightest price and then the best trading conditions for every market scenario. Also keep up with me on my socials, Common Forex on Instagram, Common Forex on Telegram, Common Forex on TikTok, Common Forex on Twitter as well. As always, thank you for joining me in this one. See you in the next one.